our today's session. We'll begin with our today's session. So the agenda is quite clear. We are only going to discuss about ICDs, intercorporate deposits. So we have Ruchir Shah with us, and Ruchir basically heads the strategy at NDX Financial Services Pvt Ltd. And with his 14 years of experience across tech, financial services, and as an entrepreneur, he has actually also worked with some of the large corporates like Accenture and Citibank. And currently, he is building a platform at NDX for democratizing access to fixed income investments. And along with Ruchir, we also have Gautam Adhukia, who is the co-founder at NDX Financial Services Pvt Ltd. Though Ruchir is going to run the entire presentation for the next 20-25 minutes. And after that, Gautam is also going to be part of the Q&A session. And what we've planned is, unless you absolutely don't understand a specific terminology or somewhere, then you can probably just raise your hand and Ruchir can explain you again. Or else we can have the question answer session once Ruchir finishes his presentation. So, as I said, today's topic is what is ICDs? How does it function? Does it meet the more important SLR principle, that is safety, liquidity, and returns? Does it meet that? And how does ICD fit in your scheme of thoughts? Like in your finances, how does it fit? So for this, I'll request Ruchir to take over from here. And Ruchir, it's over to you.
All right. Thank you so much for, first of all, giving us the opportunity to come on this platform and speak to all of you. From the preliminary interactions of Nidhi, I do understand that we have a very educated and informed audience. And I look forward to presenting our proposition. But the way I'm going to present is not कि यार ये ICD है ये रिटर्न है एक्सेट्रा एक्सेट्रा आई वांट टू scratch the fundamentals in terms of how should you consider looking at this investment, what are the parameters that should be evaluated, as you rightly mentioned, the SLR, the safety aspect of it, the liquidity aspect of it, the risk aspect of it. I'll try to cover all those, and then at some point in the presentation I'll of course introduce the proposition itself. uh, I have a few slides. I'll go through them to set this up. But before I start, Swapnilji, is my screen properly visible?
Yes, it is.
Perfect. Let me just hide this. Just give me 1 minute. All right. Since we've gathered here today about intercorporate deposits, let me start off with yeah. Let me start off by actually talking about, right, all of you over here are in some form and shape trying to optimize your PNL. You at the base level, you are trying to either and the way to do it, of course, is you grow your revenue, you cut your costs, and then there is the opportunity that sits within other income. This is capital or money that you have that you are looking to deploy for short-term needs, something which is a part of your working capital or part of your treasury. And you need the right way to be able to deploy this, which has not that much of a risk attached to it. And of course, the guarantee that you should be able to get your money back when you want. Now, when you look at the opportunities at hand, you of course have equity, but it is a little bit more long dated, long term horizon, and it's more volatile. You do not have that predictability, and you are trying to get that additional alpha, and that's where fixed income plays a role, right? You have that instrument in fixed income. The fundamental thesis is that you have a known return, you have a known date, and it becomes the right tool, and hence fixed income plays a very important role here. Now, so just a second. When you look at, and we were just having this conversation, right? Ki, ICDs were there over time. They, in some form and shape, phased out. A lot of people end up doing, let's say, taking the base example in fixed income is fixed deposits, right? In fixed deposits, you get somewhere around 4 to 6% returns. There is a lot of gap between what the bank lends at versus what you actually get. We have tried to cover this gap with peer-to-peer lending. But the problem with peer-to-peer or the cap or the limitation with peer-to-peer was that we could only do up to 50 lakhs per PAN. Now, liquid float, as we would like to call it, right? The RICD offering liquid float is built on the ethos that it is built for your larger balance sheet, right? If you want to optimize your balance sheet and you want that incremental alpha and incremental returns, then how do you get there? And that is the instrument that we are trying to create over here. But before we go into the instrument itself, let's understand what are your current options. Generally speaking, you would end up keeping money in your current account. You would have it invested in your fixed deposits, or you would go into some sort of debt mutual funds. Now, we have a simple comparison table. The summary or crux of this entire table is that your returns are anywhere between 4 to 6%, 6.5%. Nature of returns can vary. It is if it's a current account, it is nil. If it's fixed deposit, it is fixed in some sort of form and shape. And the biggest drawback is actually down to returns and the linkage to tenure and returns, right? In fixed deposit, it is poor for short tenures. You do not get the right kind of optimization. Whereas in debt mutual funds, you are directly exposed to the default risk of the underlying paper. I will cover this in a little more depth as we go further in the presentation. But these are the instruments that you have as an option today. And when you just compare that to the returns that these instruments are giving you, right? The returns can vary anywhere between, on an average, 5 to 7% on the debt mutual fund space, 4 to 6% fixed deposit space. Whereas liquid float, you have, of course, we have multiple different products, multiple different propositions, but you can make significant additional return on this. Now let's crack this up further, right? Let's understand what is it that you actually need when you have this kind of a need. What is it that you need from the instrument to park your money? We know for a fact that it is mainly for your short-term needs. You are effectively looking for options to create or generate liquidity or ensure that you have liquidity. You're looking for some sort of flexibility, right? You should be able to select the right kind of tenure depending on your needs, depending on whether this capital is earmarked for, let's say, some planned payments, GST, TDS, etc., or it is earmarked for some sort of capex that you want to do at some point in the future, etc. So you may need for that level of flexibility, or sometimes it's just emergency capital that is lying with you, and in order to have that convenience of emergency capital available for you at any given point in time, you are probably keeping it in your current account. So that is the level of flexibility that is required from any instrument in order to meet the requirements of the corporate for which the need has to be created, right? And then there is risk, which is one of the most important parts, where what is the risk that you are taking? And we'll go through the details of the risk itself. What are the different types of risk? What is the risk that you are taking, and how do you evaluate those risks? And probably also help you understand to the best of our ability on how do we mitigate some and all of these risks to the point and shape that we can. Lastly, of course, it's the ease of operations. Most important is that it should be seamless, it should be straightforward, it cannot have any sort of cumbersome processes that are involved in this entire piece. Let's address that, right? When you are looking for liquidity, our product or our offering provides you anytime liquid, right? It is one of the features that of the product itself is that you have no exit load, you have anytime liquidity as one of the features. Flexibility, we have different schemes based on the holding period that you want, right? Whether it's 3 months, 6 months, 9 months, 12 months. So there are a lot of these different types of schemes that we have. And it is for you to select which is the scheme that you need. Of course, as the holding period keeps on increasing, your returns also keep on increasing, and that's how the schemes are built. You have ease, straightforward process. I will go through the operation process itself is quite straightforward. You just have to sign an agreement and then there's transfer of money, etc. But the process is as simplistic as we can get. And last but not the least and most important criteria is risk. Let's go into the details of risk itself. In order to understand risk, what I've done is try to understand what is the risk in your existing current instruments that you have, right? Existing optionalities that you have, and from there I will try to derive as how we have tried to mitigate it structurally as a part of our offering. Let's talk about fixed deposits first. You've invested, let's say, a crore, X amount of money, and you've given it to the bank. The bank becomes the entity on to which you've given that money. You've lent that money. The bank does further onward lending with that money. It gives it at about 8 to 10% to the companies. The companies give it, the corporates give them a certain return on that contractual arrangement that they have, and the bank then further gives it forward. Of course, the range is anywhere between 5 to 6%, but if you're holding for a short period of time, the effective return comes out to be around 4%. So that is kind of the money flow, right? The advantage in this entire piece, of course, is that the bank holds the underlying risk. Your money is in some form and shape protected because the bank is there to be able to compensate you, irrespective of the nature of what the borrower is has the ability to pay or not. The downside, of course, is that you do not get the commensurate risk return for the holding period that you are doing. So the return is not that lucrative enough. Now let's compare this to what a debt mutual fund is doing, right? When you are investing via an AMC in the underlying securities, which is in all likeliness some sort of NCD issuances, the money is directly going to the issuers, and you get a certain amount of return, let's say approximately about 6%, in the range of 6 to 7%, 6.5%. But now let's understand what happens to the risk. The moment there is a default of the underlying, the risk automatically shifts back to you as the investor, and hence that becomes a very big criteria in the evaluation process itself as to where the underlying money is going, because the AMC is just a pass-through entity. So you are probably taking more risk. You are taking more risk than an FD, and hence you are getting slightly better returns. But the risk itself comes down then to your selection criteria in terms of which fund issuances, which fund houses, what is the underlying securities that you are taking in this. And the AMC itself does not have any skin in the game. What we've tried to do is try to, of course, combine the best of both. When you lend to us, you get into a contractual agreement with us, just like how a bank is there. We are the contractual lending, we are the contractual entity. We take the underlying money and we get into an obligation where we have to pay you that money, this money that we are guaranteeing to you, that we will pay you back. Our business model is nothing but taking this money and investing that into further NCDs. All right. So we, of course, invest in a lot of different NCDs, and they are AAA all the way to BBB. That model itself of how do we invest, what are the risk analysis, etc., I will get to at a later point in the slide deck. But our sweet spot lies somewhere in the AA category, and hence we get a certain amount of blended return, basis which we give you the return back. And that is the crux of our business model, as to how we've tried to blend both of the different the best parts of both worlds and try to give you significantly better returns when you are investing in this particular instrument. At the same time, try to mitigate whatever risk we can and reduce the risk exposure at your end. Let's understand this further. When you are talking about why is it fundamentally structurally safe, right? When we talk about a bank, for every 9 rupees that you put in, the bank puts in only about 1. And of course, these are directional numbers just to help you understand the concept as to relatively to make you understand the concept of how this works. For every 9 rupees that you're putting in the bank puts in only 1, right? So they have 9:1 as the ratio in terms of the debt to equity. Whereas for us, every 1 rupee that you put in with us, we have our own 1 rupee. Currently, our debt to equity is 0.2 is to 1, right? But our maximum threshold that we'll probably stretch this at some point later in the future, that we may effectively stretch it at, is 1:1, not beyond that. What this effectively means is that only and only if 50% of everything that we've borrowed and the underlying security against for which we purchase, if all of that defaults simultaneously, is when we will run into a scenario where we may not be able to meet our obligations. Till then, we have enough capital that we can, through which we can cover all our debt obligations. Also, it is important to note that we spread across our investments across multiple different issuers at where the underlying security is expiring at multiple different points in time. Right. So the underlying exposure of our business investment is diversified enough, and we have more than half of it is locked in nature, right? It is not kind of sitting in any sort of liquid instrument. Whereas in bank, it is almost fully liquid. The entire money is in some form and shape fully liquid in nature. So there is enough and ample safeguards in the business model itself through which we are ensuring that there is not a scenario where we can probably run into where we will not be able to repay our debt obligations. For this scenario to occur, where 50% of everything that we've invested in kind of defaults simultaneously, it's of course never happened. Neither happened in 2000 now, nor happened in 2008, neither in COVID. And if this happens, it is going to be a structurally fundamental question at the economy level itself. It will not be an isolated incident just to our particular corporate entity, because what we do is we diversify our investments, as I said, across multiple different issuers, and within each issuer we have a certain level of exposure that we take. We cap our exposure at an issuer level as well, and hence we do not take unnecessary exposure on a particular issuer. All right. And that is basically the introduction to ICD. When we are talking about, right, liquid float itself. Fundamentally speaking, as you guys already know, I'm not going to just simplify it further, but just so that everyone is on the same page. You are the lender, we are the borrower, and you've effectively given us a loan. We seal that with an agreement. You get a certain return for a certain tenure that for which you've taken the exposure. And of course, this instrument itself is secured in nature. Um, Comparatively speaking, and we'll run through the numbers, you are getting significantly more income as opposed to a debt mutual fund or a fixed deposit. And that is how you can, what I started off is optimizing your other income avenues. That is how you will be able to optimize your other income avenues through this particular offering. Now that we've established, what is an ICD and how should you look at an ICD, let's answer the question in terms of how do you evaluate, right? When you look at investment consideration, how should you go about evaluating this particular opportunity, both from an internal assessment standpoint, which is more internal to your corporate, as well as an external assessment standpoint, which is more towards us as a company, as well as the instrument itself. Let's talk about the internal assessment first. The three, and there could be more criteria, but we've tried to enlist some of the important criteria. If the answers to the following questions are yes, which is, does your investment mandate allow a product like this? These are more like filtration criteria, right? Do you have idle funds that need short-term parking? And is that money earning less than 7% today? If all of the answers to these questions are yes, then this becomes one of those fitment checks that, okay, yes, this instrument can be considered. When should this instrument not be considered? Let's go into that as well. If you have a short-term working capital need where you can deploy this money in your own business itself and you are expecting 15%, 20% plus returns on that, then do not invest in the ICD, because you are losing out on opportunity to invest in your own company, whereas investing in this. So that is one of the scenarios when you should not consider investment here. If you have any sort of underlying debt which is costing you at around, let's say, 12% ish, retire that first. That is a cost to your company, and you will be better off optimizing that cost than to invest this money in an ICD. If you have very, very immediate need, let's say in 4, 5, 7 days, it's not like you can't do it. Of course, we have a fully liquid feature itself. But then if the quantum is high enough, then it makes sense for you to invest here. If the quantum is low enough, you will not make that amount of significant returns on this particular investment. So if it's just operational float and you have very urgent needs, 4, 5, 6 days, and if the quantum is not that high, maybe you should reconsider whether you want to invest or not. Having said that, these are all the internal assessment criteria. The more More important thing is, of course, when you are looking at this particular instrument assessment, you would try to address the three fundamental questions. क्या इसमें मेरा पैसा बनेगा? What is the returns that I can get on this particular instrument? क्या इसमें मेरा पैसा डूब सकता है? Right. What is the counterparty risk? If at all, who is the counterparty and what is the counterparty risk that you are taking? And underlying instrument itself, what are the risks to the underlying instrument? Can I get my money back when I want? Can I get my money back? Or what are the fundamental ways in which there is a certain level of risk on this particular instrument and how these can be mitigated? The next few slides, I will try to cover each of these three pillars. Let's start with returns comparison first. Already covered in previous slides, but just to kind of give a like for like parallel in terms of where your money lies today versus where within our schemes, where can this be invested? If you have money lying in your current account, which is earning you 0%, and the time period of investment is somewhere less than 30 days, it is contingency float, it is just easy money that you want at any given point in time, go for our liquid schemes. If you want, these are fully liquid in nature. If you want debt mutual funds, let's say up to 12 months, which is earning you 5.5% returns at any given point in time right now, go for our flexi schemes. And if your money lying in fixed deposits, nature is more locked in nature. It is more like long term in nature, relatively medium term in nature, not long term, but relatively medium term in nature. Go for our lock-in schemes, right? So we have these three different schemes: liquid, flexi, lock-in. I'll try to cover that again at the later point in the slide deck, but this is just to kind of give you a sort of semblance of understanding as to where the different schemes that we have are fitting in. Liquid is where you are fully liquid in nature. Flexi is a certain amount of time period horizon for which you are investing in, and lock-in. And each of them have their own set of nuances, minimum period of holding, how much can you invest, all of those things, which we will cover as we move further. Now I'll come back to this slide. We've covered returns. I'll try to cover counterparty itself, right? I've been speaking a lot. Ruchir, Gautam, Swapnilji has introduced us, given us the platform. Let me now formally introduce who we are. To understand our journey, first let's understand the founders themselves. Gautam, Adhukia and Achal Mittal. Both are MBA. Gautam Adhukia is from IIM Calcutta. Achal Mittal is from NMIMS. They have worked in financial institutions themselves. The first venture that they were working in or they co-founded was Rento Mojo. It as some of you might know, it is a furniture rental startup, but at the underlying of it, it was a peer-to-peer model towards furniture lending because they raised money from HNIs, ultra HNIs. They gave them a certain amount of return, and that money was used to lend out furniture, and then they got some returns from there. So they had like a peer-to-peer model with Rento Mojo, with the underlying asset here being the furniture itself. They successfully exited that, and then they started this company by the name of NDX Financial Services Pvt Ltd, as we now like to call ourselves as Liqui One. This holding entity has three subsidiaries, as you can see over here, 2, 3, and 4. So number 2 and number 3 are NBFCs themselves that we operate in some form and shape. Trillion Loans is a pure play NBFC, and Liqui Loans is a peer-to-peer lending NBFC. Liqui Bonds is a third wholly owned subsidiary over here. And I will try to introduce each of these three now, right? So Trillion Loans, we have 24% holding. It is a joint venture between us and BharatPe. We built a book of about 1,500 crores over here, AUM. And we did secured lending verticals such as gold loan financing, two-wheeler financing over here. Liqui Loans, peer-to-peer entity. In peer-to-peer lending, we built the largest, the entire industry was at a 9,000 crore AUM at its peak. We built the largest entity over here at 5,500 crore, all thanks to our distribution network and trusted fund advisors who helped us build this level of AUM on Liqui Loans itself. And Liqui Bonds is the third venture under NDX Financial Services, where we are trying to move into the larger financial story out from just lending and peer-to-peer investing towards creating a holistic wealth platform, wealth instrument distribution platform toward primarily focused around fixed income. So via liquid bonds, we are doing NCD distribution itself. And at NDX Financial Services, the holding company level is where we are currently talking about, because that is the ICD opportunity through which we end up creating the other opportunities that you can see right here. Just a little bit of numbers. Uh, our last funding round was at the valuation of 200 million, and 10 million was the investment that happened was at 10 million by Cred. And Kunal Shah, who's now the CEO of WhatsApp, was an early investor in Liquid Loans itself. Um, to let you know, we have been PAT level profitable since the last 4 years, and we operate primarily through our own money, right? We have not, the founders still own a majority portion of the company itself, and we primarily operate this company with a very tight unit economics, such that we are able to run the company through our own capital. Now that I introduced liquid loans, I wanted to, of course, address this point head on. For some of you, you might be knowing liquid loans, some of you might not be knowing liquid loans, but there was a lot of chatter around peer-to-peer lending in 2024, right? There were revised guidelines that RBI issued in 2024. The guidelines fundamentally changed how peer-to-peer lending should work. The guidelines fundamentally changed the unique value proposition through which we had come out with, and the revised guidelines did not make it amenable for us, where we felt that it is no longer that conducive enough for investors from a risk return arbitrage, right? The risk significantly increased, the convenience significantly decreased, and it did not lie with the right kind of ethos or the business model with which we wanted to continue building the business. So even though at a 9,000 crore industry AUM and 5,500 crore peak AUM that we had, we decided to take a structural call that we do not want to continue taking fresh investments in P2P. And as we stand today, every ICD obligation that we had at that point in time has been returned in full, and every lender who had lent money to us on the P2P platform has received their money back, principal plus interest, no haircut. We have given everything back. And that is the proof of how we are able to manage and underwrite risk, right? To understand that we have been operators of NBFCs, we have a very strong and robust risk engine. We took a call not to take any fresh money, and we were able to wind down our book to its entirety in success. And very few companies out there are able to, prove this. And that is where we were able to clearly demonstrate that we do not take any sort of risk which is too high in nature. Just growth at all costs is not the way we operate our business. We are very, very unit economics focused, and we have demonstrated that through our historical experience itself. Now, just to extend this particular analogy further, because we have had an experience in running NBFCs for a good 5-6 years and scaling them up successfully, and 70 to 80% of all issuers of NCDs are financial institutions or NBFCs in nature. We actually understand their internal risk assessment also very, very well. Not only do we have a very good ecosystem in terms of how these different entities operate, but what should we analyze, what are the ratios, what is the management pedigree, all those insights we go and bring about, and that is how we decide which underlying instrument should we invest in when we invest in NCDs themselves. And that is the experience that we carry forward in the new lines of businesses that we are also operating in. Now that I have addressed counterparty, I wanted to now address the underlying risk itself with the instrument. Interest rate risk, there is no interest rate risk, technically speaking, because the rate is fixed when you sign. All right. Liquidity risk, I will try to cover this. I've tried to cover some aspects of this earlier in terms of trying to say that, how we manage our balance sheet and how we manage our obligations. I'll try to cover this again. But again, it is quite easily managed with the way we have our overall debt obligations and the equity portfolio that we have and the underlying instruments that we have, through which we are able to manage and we are able to provide liquidity very easily as and when you need it, because we look at our overall ALM in a very tight manner. And credit risk, the risk of the underlying instrument itself, right? And this is a significant call out which I would want to cover, right? There is of course this concern that might be there, what happens if the underlying instrument defaults. Now, to understand that there are multiple different issuers out there in the market, but at any given point in time we hold only 40 to 50 issuers on our book, and we hold all of them on our book. Reason being that we've done a thorough credit assessment, credit check on each of these issuers. And on the table on the right, you can see that these are CRISIL provided data, the historical default rates over a 10-year period of different instruments, right? So there is a very low default rate of all of these underlying papers that you can see, and we try to mitigate this by doing a very thorough credit selection of which papers do we want to invest in. Our concentration mainly lies in the A-rated category, but there is of course a mix of all the different papers in which we end up investing. Also, fundamentally, now this is on the paper selection level, but fundamentally, which I was talking to you, right, at a maximum level, if we go at 1:1 itself, right, and these are of course directional numbers, these are not absolute numbers, but just to give you an understanding that if we have 100 crore of our own equity and 100 crore, let's say if we've hypothetically raised at via ICDs, although as I told earlier, this ratio is more at 0.2:1, our equity significantly outweighs the debt that we have. But even if you go as on 1:1 and all of it is invested in bonds, you need 50% of entire of our issuances to get defaulted simultaneously for this money to get wiped off, which seems a more of a theoretical scenario than a realistic scenario itself. And that brings me to the end of the presentation. This is just a basic check as to who can invest. An ICD is a company to company investment. Private limited companies, public limited companies, and all listed companies can invest in this opportunity. How to invest is just operational in nature. So for the purpose of this conversation, I'm going to skip this, and this can be covered in detail with the advisor itself. And that's about it. I think we've reached the end of the presentation. Let me open it up now. Let me introduce Gautam first. So Gautam is our co-founder. I've already introduced him. He is there on the call, and he'll be happy to answer any questions that any of you might have post this presentation. So Gautam, over to you, and Swapnilji, over to you to take it forward from here.
Thank you, Ruchir. And Gautam, welcome. Yes, so with this, we end the formal part of the presentation, and we can have question answers in detail on whatever you want to understand on the safety part, liquidity part, and the return part. One more before we begin the question answer session, Ruchir, are cooperative banks also allowed to invest into ICDs?
Sure, Gautam, do you want to take that question?
Sure, I'm just joining from my laptop in a second, but I'll answer this. Yes, so as long as their charter allows it, cooperative banks are allowed to invest into ICDs. So it's a function of their charter, their internal bylaws. Generally, in our experience, most of them have not thought of this and it's not included. So some of them need to modify their charter to be able to invest into ICDs.
Okay. Yes. So I request all the participants, since most of you are either chartered accountants or managing the company's finances, whatever you would like to understand about the ICDs, as I said, in terms of the safety and the liquidity part, please feel free to ask the questions.
Sorry, I know, Ruchir, you covered the security aspect of it, but probably I missed it and didn't understand it clearly. If that can be elaborated again in terms of how this is a secure instrument, that would be helpful.
Sure, maybe Gautam, would you want to take that up?
Yeah, sure. So all of the ICDs, sir, are secured against the underlying assets of the company. Now, generally, when security comes in, one needs to understand what the assets of the company are. And in case of a default, are they valuable? As we've seen with a lot of companies that have gone through the IBC code, by the time it comes to liquidation, a lot of those assets don't hold any value. So in our case, all the underlying assets are actually securities of some other firm. So their value is independent of how our balance sheet is placed. But having said that, the only scenario that Ruchir highlighted where a default can happen is there's an en masse default of securities of some of the prime firms in our country. But re-summarizing, all of these ICDs are secured against assets. And typically, until our debt to equity ratio goes up, the coverage is as good as we speak right now, it's 5x. And at peak also, it'll be nothing less than 2x.
Got it. Okay. All right. Thank you. That's helpful.
So Ruchir, you said 50% till the time 50% of the holdings in NCDs go burst, the money is safe or there won't be a default. But how about like a couple of NCDs getting default? In that case, how does that impact an ICD investor?
So again, I'll answer that, Swapnilji. So there's no impact. In the example that Ruchir gave on one of the slides, if there is, let's take the theoretical maximum, there's 100 crores of ICDs and 100 crores of equity. 200 crores is invested into a mix of bonds. Practically, it'll be, let's say, 180, 190, 10, 20 will always be cash. But for the sake of argument, let's assume the entire 200 is invested into bonds. And say we hold 50 securities, each of them have a 2% weightage in the portfolio. Now, if 5 of them default, then the total loss is 10%, which is 20 crores. So what does the P&L for that year look like? We've lost 20 crores. Equity gets diluted from 100 crores to 80 crores. And the NCDs are all safe. Scenario 2 is that there is a higher amount of default. Say there's a 30% default. On 200 crores, that amounts to 60 crores. So our equity gets wiped out from 100 crores to 40 crores. ICDs continue to remain safe. At 50% default ratio, equity goes to 0, and ICD still remains safe. Anything above 50% default on all the bonds at the same point in time. So there are two probabilities that have to play out. There has to be a 50% default, and it has to be simultaneous in nature. So if there's a 60% default, it amounts to 120 crores, at which point of time ICDs get 80% of their capital back. They still lose only about 20%. But like we've discussed, even in the worst of scenarios like COVID, the overall default, not on A names, across the entire rated universe of CRISIL did not exceed 2.5%. So for A and AA kind of names to hit a 50% default ratio, it is a possibility, but the probability of it is very, very, very minute.
Okay. Okay.
So the way to compare this is not in terms of an isolated risk. Whenever you are investing, think of this as, and this is a closed person, so I'll speak a little bit more openly. Think of it when you're investing into a debt mutual fund. That money is going into the same or similar 30, 40 securities. The moment the first security defaults, that default is passed on to the unit holder. Again, it happens quite rarely, but whenever it does happen, it is passed on to the unit holder. Here we're saying you're investing theoretically into a pool of securities which are similar to a debt mutual fund, but the first 50% of default is insulated for you as an investor. So अगर 50% तक default होता है, तो investor does not get impacted. Compare that to a debt mutual fund, the first default also you get impacted. But also to highlight the risk, most debt mutual funds generally AAA or AA में डालते हैं. We are more on the slightly higher side of the risk curve, which is concentrated around a median of A+. But the probability default, as we've seen in the previous slide, is not more than 10-20 basis points extra. अब उसके सामने if there's a 50% buffer ratio or margin of safety before which the investors or ICD holders take a hit, that actually theoretically one can argue is safer than investing into a debt mutual fund. So AA securities with zero margin versus A securities with 50% margin of safety. Mathematics or statistics model would say the second one is safer.
Right. Right.
Hi, I had just a couple of clarifications. If you could just help me understand if I've got this correct. So you're saying for the investor or the lender in this case, even if the underlying securities default, the equity investor of your company will lose, not the lender, as a first
Correct.
threshold till 50%,
Correct.
right? And this is fair. And the second understanding is when we're talking about ICD, the ICD is to NDX. And when you say it is secured ICD, the underlying security is your investment assets, or what is the underlying security when we say it is a secured asset?
Sure. So right on the first count, this slide explains it quite well, rather. The 100 crores is what the ICD holders put in, and this again indicative numbers. The numbers are higher, and 100 crores is our own equity, both of which gets invested into bonds worth 200 crores. So these bonds then become the security against which your ICDs are covered. So if, let's say, theoretically NDX ceases to exist, the liquidation professional will come in, liquidate these 200 crores of bonds, and pay back the ICD holders. Now, because this is 200 as compared to 100, any loss will first get eaten up by the equity holders. So if there is a liquidation, they will say first 100 crores goes to ICD, and the remaining goes to equity investors. This is part A. Sorry, you had a second part of the question which I just forgot.
So I was asking, you said these ICDs are secured ICDs.
Correct.
So the underlying security is what, the assets that you invest in, or how
Yes,
is it?
the same bonds. So the same set of
Okay,
bonds that we invest
got it.
into, the securities get covered against those.
Okay, fair enough. Thank you.
And generally, the cover at 1:1 will remain 2:1. So for every 1 rupee of ICD that has put in, the underlying assets would be worth 2 rupees on an average.
Gautam, can you throw some more light on the liquid ICD part? How does it operate? And
Sure. Ruchir, can you jump to the current account versus FD versus the three use cases? So, like we mentioned in one of the earlier slides, what we tried to do is, one, we realized there's a gap in fixed income. Uh, Now, banks, obviously, if you look at any of their presentations or their investor calls, the one number that they proudly say is, "Hamara CASA ratio is so much, it has gone up from 50% to 55%," because that is the lowest cost of funds for. So generally, there will be limited motivation for them to, come out with innovative products which are better for their customers and cannibalize their own lowest cost deposits. So we went back to a drawing table and realized for most corporates, unless you have very long-term capital available, that will go towards equities. But short-term money or short-term parking up to 2 years will always go towards fixed income. But there weren't any good instruments to offer to corporates which, met their respective or customized needs. तो इसे तीन जगह आज पैसा इन्वेस्ट होता है करंट अकाउंट में पड़ा रहता है पैसा कई कंपनीज का 1 2 3 4 crores which earn 0%. Now they want flexibility, so they don't park it in a debt MF, they don't park it in a fixed deposit. That money can come into the liquid value proposition that we have. This is money that you are not sure when you will need. You could need it 7 days later, you could need it 25 days later. It is not towards a planned expenditure, it is towards just emergency parking for any unplanned expenditure that might come up. So that money, instead of earning 0%, can earn 8%. The second option was when you had some medium-term surplus, which you said might be required in the fourth month. Again, the exact time was uncertain, but you said at least 3 months के लिए नहीं चाहिए. Fourth month में शायद चाहिए रहेगा. That money today goes towards a fixed deposit of 3 months. Now the challenge there is, if you do fixed deposits below 1 year, the rate that you get is very, very low. Generally 4.5%, or sometimes even lower. So then, even though you've locked in your money for a certain amount of time, the return is not very good. In that case, when the expenditure is planned or there is some certainty towards the timing, which is either at least 3 months away or at least 6 months away or at least 12 months away, that money can go towards the lock-in ICD. So thereby, instead of earning 8%, the investor can earn up to 10% returns.
okay, but in the liquid part, how is it? Like, if suppose an investor invests, say, 50 lakh rupees, can he partially withdraw it like a liquid mutual fund, or can he
Yes.
is there any regulation, or is there any rule from your side in terms of reinvestment, withdrawal? How does it
There
work?
is only one cap, sir. That cap is at 2.5 crores per month. So if you invest, say, 2 crores, there is no questions asked, investment and withdrawal up to 2.5 crores. If someone has invested 5 crores, then they can withdraw only 2.5 crores in a month. And this number will keep going up. As you've seen, we've been very disciplined with how much we offer in terms of liquidity, even in P2P days. And that helps in both good as well as bad days. So यहाँ पर अगर आपने 5 CR डाला है, तो you can withdraw, let's say, 5 CR in 2.5 CR in July. Then after 15 days, you can withdraw the remaining 2.5 CR also. So let's say you did a withdrawal on 31st of July of 2.5 CR. On 16th of August, 15 days later, you can withdraw the remaining 2.5 CR also. But you can't withdraw 2.5 CR in July and 2.5 CR in August, because then that is equivalent to 5 CR entirely being liquid. So the maximum in a month is 2.5 CR. And once you have used up the 2.5 CR, for the next 2.5 CR, you need to wait for 15 days. This
Okay.
cap generally is already comfortable for most corporates, right? Anyone who's starting will probably not start with a large amount. They'll start with somewhere between 25 lakhs to 50 lakhs, and gradually they'll keep building up. By the time most investors reach that comfort level, we would have also bumped this cap up a little bit.
Okay. Okay. And for
And that is going
amounts less
to
than
be
two
my
and a
next
half
question.
crores, for amounts less than 2.5 crores, there is a
No questions
possibility
asked.
that partial withdrawal is also possible.
Yes.
Okay.
And so the ease of withdrawal is also very easy. You can send an email and the agreement covers all of this.
Okay.
So then all you need to do is send an email, get a confirmation, and the money will flow back.
But in a typical liquid mutual fund, an investor even gets return for Saturday, Sundays, or an extended weekend. So how does it happen in case of a liquid ICD?
It's similar. The construct is similar. Till the day or till the previous day of the withdrawal, you will get the interest.
Okay. Okay. Chetan, you had a question?
Yes. What I've understood, like someone who wanted to invest in a high risk instrument is now a comfortable option where, 50% or almost entirety of the risk is shared by NDX. So that is
Correct.
pretty exciting. But then what I want to understand is you said like there's a 50% equity that is contributed. Now, it being such an attractive proposition, I am sure the lenders will increase very fast. So how do you keep matching the 50% equity? I mean, do you every time raise equity to match it, or how does it work?
Sure. So, firstly, very relevant question, that will there be a temptation for us to, raise more capital and deploy? Now, let me just explain the context of why we are doing this. We are not a asset management company who is wanting to, take money at a certain rate and deploy it at a certain rate on the spread. We are already into the bonds business. Because we are in the bonds business, there's a certain amount of inventory that we hold, which gets sold out on a 2 to 3 month basis. Because issuers, जैसे अगर let's say if I've gone to Tata Capital today, they will not keep doing a issuance every second day or every week. They will do a issuance once a month, once a quarter. Then I need to buy that inventory and keep it so that I can sell on my OBPP platform in the next 2 3 months. Now, owing to this, there will never be a temptation to keep raising capital or keep raising equity if the demand of the OBPP platform, which is our bond platform, is say 200 crores. Then, if we have enough equity, we will only fund that to equity. If the demand goes up to, let's say, 300 crores, we'll raise 100 crores of debt. So, there is a natural ceiling that we have in terms of how much will we raise and deploy, owing to how much do we sell on the OBPP platform. And over a period of time, that will also start becoming efficient. Historically, in P2P also, we had this temptation, but we have always been more cautious than aggressive, where we'll work with a smaller balance sheet where we are more confident, because the moment there is skin in the game, like there is in this case, if this goes to 1.5x to 1, then also the first set of defaults hit us. So there will never be a case where where we don't need to invest into those bonds. We would have raised debt capital and invested. So that is not the business that we are in, that we will raise money at 8 and deploy at 10 and earn the 2% spread. So in the near future,
Got it.
we don't see this as because we've already been operating, we've just about hit 0.2x. Now what will happen, Chetan, is in the next 2 or 3 years, till the time we hit 1x, we would have already earned some more internal approvals in terms of our yearly P&L. So equity without raising external capital would have gone up. So let's say today, if we are at 400 crores of equity, next 3 years, if we make 50 crores a year, which is the underlying return on these bonds at the very least, that equity has already gone up by 35% in the next 3 years without raising a single rupee of external capital.
Got it. So you're saying the threshold of 50% equity is still far, and by that time, you'll have much more equity watches through accruals itself.
Correct. And whenever that is the case, right? So because we've been very, very transparent, and Swapnilji will know this, whenever we are even close to 1x, which is say 0.8 or 0.9x, we will send out that communication. So I don't see that threshold hitting in the next 3 years at the very least. So जब वो होएगा, we'll communicate and say now we revise the threshold if at all from 1x to 1.1x or 1.2x, and allow all investors a chance to withdraw if they are not comfortable with that number.
Chetan, does that answer your question? Fantastic. Any more questions?
Yeah, I had one question.
Yes, sir.
I didn't get a sense of what was the minimum ticket size, if there is any, to start with.
The minimum ticket size is 10 lakh of rupees.
Okay, so you start with a minimum of 10 lakhs.
Correct.
And this is strictly ICD format, so LLPs or partnerships cannot come. Correct?
They
This is
cannot
what-
come, sir. For them,
Yeah.
we have an alternate offering. So if someone is comfortable with the NDX group as a whole, we have got NCDs also where they can take an exposure. So owing to the corporate limitation that is provided by law, only
Yeah.
companies, be it public or private, can invest into ICDs. Anyone else can take an exposure to bonds of other companies or bonds of the NDX group if they are comfortable with our group.
So maybe we can then have a separate conversation related to the bonds. I'd love to understand that also separately.
Definitely.
Yes.
All right, thank you. No questions from my end.
Any more questions, gentlemen? Gautam, any role Kunal Shah will have once he's the CEO of WhatsApp? Would there be any possibility to leverage his role?
I think he has, so from what we've spoken, he's sort of excused himself from his responsibilities at Fed also to a large extent. And because the reason he's been brought on board is that there's a lot of things that he needs to accomplish at the WhatsApp level itself. And he's obviously permanently shifting to SF or San Francisco in September. So we'll stay in touch, but I think directly he will have limited time available. He continues to, interact with us to guide us on how to build this better. But on a day-to-day basis, he will not have any.
Sure. Okay. Yes. If we have any further questions, or else we can. Yep. So.
I just had one comment. It is Gautam, the founder, right?
Yes.
So first of all, congrats. I mean, you guys really create amazing niche products, and of course, we'll be in touch with Swapnil on what we want to do next.
Thank you so much, sir.
Just one question. All the intercorporates you receive are necessarily into the bonds, right?
Yes.
Invested into the bonds.
So just to be clear, there is, let's say, an equity balance sheet that we have.
Okay.
Now, out of which, if we own a stake in Trillion Loans, which is the NBFC that we have partially diluted to Bharat Pay, that
Okay.
will continue to reflect on the asset side of the balance sheet as one of the investments on the balance sheet. So because balance sheet itself cannot be segregated, but at all points of time, if there is 100 rupees of ICD or 100 crores of ICD or 400 crores of ICD, there will be bonds which are worth at least 2x. And then there might be other assets in the form of cash or equity investments that we've made into either the group companies or associate companies that will also reflect on the balance sheet. So theoretically, the cap is much higher, but I did not include that here because from a liquidation perspective, they are illiquid assets.
Okay.
But
Okay.
most of them are still valued, like the Trillion Loan stake is valued at book value, although the real value or the market value is at least 10x higher of what is reflecting on the book side. because this is something that we'd invested in 4 years back when the company was probably 5% of the current size.
Okay.
Okay.
Fine.
Sure. That's it. I think, thank you, Gautam. Thank you, Ruchir, for a detailed explanation on ICDs. And thank you, all the participants, for making this an interactive session. I hope you've got a good understanding how the ICDs are currently managed by NDX and how are they managing the safety liquidity part. And of course, return, as I said, was a no-brainer because it's almost 3 to 4% higher than the alternative option. But the more important part was to understand the how safe are the ICD offerings and how liquidity is getting managed. So thank you so much for your time on a Saturday morning. And in case there are any more questions, please reach out to us individually, and we can also again individually connect with Gautam or Ruchir if needed. So thank you so much.
Thank you.
Right. Thank you, Swapnilji. Thank you, everyone else.
Thank you
Thank you.
so much. Yes.
Bye.
Thank you.